So, what can we learn from the past? And we're going to ask a historian who is also famous for his foresight. He forecast and has published a book about the economic crisis in Asia in the 90s. He is also a co-founder of the Library of Mistakes. And after his talk, we'll have a discussion with him and the chairman of Skagen, Tim Warrington. So it's a great pleasure to welcome on stage Russel Napier.
Hello, good afternoon. I've been lucky enough to be here since Monday, and last night I had dinner with some visitors from Iceland, and we did discuss money and we did discuss investment, but only briefly, and then we got on to the important things in life, beer and fish. Fish specifically in relation to salmon and trout, but I wanted to begin this presentation by talking about fish. This is a story you might know, but it's a very important story, and never forget it. It's the story of an old fish who was swimming along one day, and two young fish were swimming towards him. And as he approached them, he said to the two young fish, "A beautiful day, boys. How's the water?" And the old fish swam on, and the two young fish kept swimming, and one of them turned to the other and said to them, "What the hell is water?" Because they didn't realize that they were in water, because they'd always been in water. Sometimes, and I'm an old fish now, but I've been swimming in a very specific type of water, which is a global monetary system, which has produced certain outcomes for asset prices and asset price returns. And it would be the easiest thing in the world for me to say to you that the water will never change. But the water's changed. Now, Tim earlier discussed these incidents. It's a horrible euphemism, but the incidents that are happening across the world, and they're local. Let's talk about what's changing globally, what is changing globally, what will change globally, and how it changes the water. So whether you're an old fish or a new fish, this is about structural change. Now, does it play into 2024? Yes, it does. But it plays into 25, 26, 27, 28, 29. I'm going to argue it sets the scene for the next 10 to 15 years. And it fundamentally changes the nature of how you invest. Now, just so this isn't an academic presentation, I've got right on the front page what you do about this. So non-index low valuation equities. I think having listened to the presentation earlier, I should just call that Skagen Focus, actually. Just having listened to that presentation. I'm going to explain all of this later. Japanese equities, emerging market ex-China equities, old economy equities. Rana's presentation and Chris Miller's presentation were both talking about the old economy, the renaissance of the old economy here in the developed world. That's an opportunity, a big opportunity. And gold. And now look at what isn't on the list. No bonds, no S&P 500. Most actuaries, most wealth advisors would say, don't do that. That's an incredibly risky portfolio. My goodness, that's so risky. Because you don't have these big asset classes, you don't have the S&P 500, and you don't have bonds. That's risky. Not one of those asset classes is risky. Not one of them. So if the asset class isn't risky, how can the asset allocation be risky? But this needs what James referred to earlier. It's called bravery. It's not intelligence, it's bravery, particularly if you're a professional, to be that far away from what we would call the index in global asset allocation, to have no bonds, to have no S&P. That's madness or bravery. I'm going to argue it's bravery. You can tell me whether you think it's madness. The reason we're moving into a new global monetary system, the reason we're changing the water are twofold: China and our changing relationship with China, and our need to inflate away our debt. So I'll show you the data. We've got the highest level of debt relative to GDP ever recorded in human history. That's quite an achievement, given that we fought 2 world wars in the last just over 100 years. And the amount of debt we accumulated to fight 2 world wars was not as much relative to the size of the economy that we've accumulated today. We're going to get out of that by doing a thing called financial repression. Sounds easy, we'd inflate away the debts, but it's much more complicated than that. A financial repression to reduce debt doesn't just generate inflation, it has to hold down interest rates while it does so. And that's the bit that affects you. That's the bit that affects savers, because particularly if you find yourself clutching government bonds, you're going to lose. Last time we ran this policy, this financial repression, was after World War II. We had to reduce the debt burden. Had I owned a British government debt instrument in 1945 and held it until 1982, I lost 89% of my purchasing power. There were, very occasionally, one-year opportunities to be in the market and out of the market, but these things were called certificates of confiscation. And that is what they are again today. You cannot inflate away your debts and produce good returns for bondholders in real terms. So you have to be particularly wary of bonds. I'll maybe get a chance to talk about the euro later, but it's very difficult for the euro if we have to move to financial repression, because France needs to inflate away its debts, and Germany doesn't. We'll talk later about how that might play out. And I've mentioned the equities already. And the second reason that the world changes is China has to inflate away its debts. And its old monetary policy, which was basically trying to link to the dollar, is over. And that's been the water we've been swimming in. I'm going to move on to that water now. So the global monetary system, I had the good fortune to almost annually meet Paul Volcker. And Volcker had been in the room to establish global monetary systems, but he referred to the system that we've all been swimming in as the non-system. That's what he liked to call it, because it wasn't devised in a room. There weren't lots of politicians setting it up. It wasn't Bretton Woods. It wasn't the Smithsonian. But what it was is China devalued the renminbi in '94 and then would not let their currency rise against the dollar. And then we had the biggest movement of humankind in history, the movement of the peasants into the cities, massive capital investment, and China ran this extraordinary current account surplus and capital account surplus, because capital poured in and capital wasn't allowed to come out. And what did that do? Well, what it does is it forced the People's Bank of China to intervene, and they accumulated huge amounts of government bonds, US government bonds, German government bonds, French government bonds, and they weren't alone. The whole of Asia was doing this, and the number they racked up was over $5 trillion worth of purchases of our debt, the developed world's debt, between 1994 and about 2014. They massively depressed interest rates for the developed world. And how did we respond to that? Well, the S&P 500 responded to it by doing the following things. First of all, if your discount rate goes down, you know that your valuation goes up. Tick, much higher valuation. 2, you borrow more money. Tick, they borrowed more money. US corporate debt to GDP is at an all-time or very close to an all-time high. C, you use that to buy back your own equity, juice up your own returns. That's exactly what the S&P 500 has done. D, well, let's get rid of all our manufacturing. Let's move it all to China. Let's become a highly geared branded product company. S&P 500, 34 times cyclically adjusted PE, the perfect product of the water that we have swum in. Hasn't happened in Germany, hasn't happened in the United Kingdom, but the S&P 500, it happened. That water changes. And the moral of the story is don't invest in the S&P 500, because they are a product of the old regime. They were brilliant at exploiting it. We've all profited from that. But in this new water that's coming along, and Rana was talking a little bit about it, it's these mid-cap stocks, it's these industrial stocks. The old days of this are over, and private equity in particular is going to have some severe problems with its access to debt. So we are going to have to go through a really big capital expenditure boom across the developed world. Chris, earlier on, he showed this wonderful chart of we do all the chips. Good news. They do all the manufacturing. Bad news. So we're going to have to do the manufacturing. They, I shouldn't talk in terms of we and they, but anyway, that's the terminology of the minute. They're investing in chips, so we're going to have to invest in manufacturing. Well, there are lots of equities that you can invest in to do that, but guess what? They're not in the indices. Of course they're not, because they've been destroyed, or almost destroyed, by China. Over 30 years of misinvestment, malinvestment, and overinvestment by China. And as we move away from that, you get great opportunities in that. We've had a system where there's been too much financial capital flowing around, which has not been funding physical capital. You know, James talked about this earlier on. What is the stock market for? Is it really for raising capital? Because it doesn't seem to be. We're going to have to go back to where that financial capital is not used for financial engineering, where it's private equity, buying back your own equity, but it's used for fundamental investment. Once again, another one of James's great comments from earlier is you have to invest in someone who's going to solve a problem. And maybe that's been the history of the last 15 years. Let's look over the next 15. What are the problems of the next 15 years? They can be a lot more basic than the ones we've had of the last 15. They can be, where are we going to get enough steel from if it's not coming from China? Who's going to build our ships if they're not built in China? So if you're looking at the problems of the next 15 years, you may find it points you back towards what we would call the very old economy, not that brand new economy. If a missile hits a chip factory in Taiwan, and I don't give you any probability on what that's going to be, what happens to the share price of the Magnificent Seven? And what happens to the price of shipbuilders? You have to work out what these problems are for the next 15 years, and they are very different from the last 15 years. So that's how this capital cycle, I don't know how many of you are familiar with the capital cycle, but that's a term that comes from two wonderful books called The Capital Account and Capital Returns, which are the investment letters of an investment firm. And it's basically saying that what you really want to do when you're investing is look at supply, not demand. You've got to look at where financial capital isn't reaching in, where financial capital isn't funding additions in production, because eventually if you don't invest in something and there isn't an increase in supply, returns will go up. And it hasn't worked for quite some time because of the old water that we swam in, because China produced all of that at uneconomic rates. And when we move to this new world, it begins to work again. And the capital cycle, you can call it many things, but it certainly favors value investing over growth investing. And the financial capital that ramps up share prices now has to start making all these things that we don't make anymore. And the most exposed companies are those who've geared up and are reliant on Chinese manufacturing. And that's the S&P 500. Now, it's a global phenomenon, but they're the companies that took advantage of it. So this would now be considered to be a risky portfolio. Not only am I telling you not to have any bonds, I'm telling you not to have any investment in something that constitutes 66% of global market capitalization, the S&P 500. But in my opinion, this is not risky. Imagine we're sitting here in 1969 and I've got everything right, and I tell you, the Bretton Woods system's going to fall apart, inflation's going to go up, and I go to Tim, he's the boss, and I say, Tim, I'm a young fund manager, and I think, or what we're going to do now is, I think we should have lots of money in gold. And he said, how much? And I said, well, I think we should have 50%. He said, look, nobody's got any money in gold. I'm going to back you to the hilt in this, put 20% in gold. Now, that was good, because we did better than everybody else. But for you, we lost money, because we weren't brave enough. Gold wasn't a particularly risky asset to own, but we weren't brave enough in the quantities on which we owned. And when I tell you no bonds and no S&P 500, that is considered to be risky. But at a time of the change in the water of a structural change, to own these assets which are not in themselves risky, but to own them in risky quantities is, I think, a different type of risk, and not a big risk, but it is a risk, certainly relative to the consensus. So that is how the capital cycle was suspended in this old system, and how, as the bamboo curtain comes down, it has changed. What will the new system look like? It's not good enough for me to tell you that the old system's coming to an end. What does the new one look like? So this is what happens in the new one. As Rana has already hinted, and as the Inflation Reduction Act already does, capital is available for those who solve political problems. That's what the Inflation Reduction Act is doing. You can benefit from that as an investor. This is the state's intervention in the allocation of capital. It doesn't have a great history, unless, and has anybody here ever flew on Concorde? That was a really massively state-subsidized cheap flight across the Atlantic. But on the whole, it doesn't have a great deal of success, but it's coming back. That's what we've just been learning about today. Financial engineering is reversed. And this is the one you have to remember, because this new monetary system we've got, and I'll talk about it, is called financial engineering, or financial repression rather. And in it, we have to keep bond yields down. And we do that by forcing savings institutions to own government bonds. Forcing them to own government bonds, because only that way does it work. And then you've got to ask, what do they sell? If I told all of you in this room, I want you to put 20% more of the portfolio into government bonds, Oh, you sell. You need to know that. Well, I'll tell you one of the number one assets they'll sell if told to do so. Because most people now invest their equity portfolio globally, so most of them have 66% of it in the S&P 500. So the S&P 500 becomes a source of funds for this. We're in the business today of quoting Arthur Conan Doyle, who's the author of Sherlock Holmes. Let me tell you about the dog that didn't bark, a famous story of Sherlock Holmes. For a year and a half now, British pension funds have been pouring money into the gilt market, the government bond market of the United Kingdom. Yields have been attractive. And the UK stock market didn't go down. How does that work? What did they sell to buy all these gilts? They sold other people's equity markets and other people's bond markets, because we live in a world where there is really very little home bias anymore. And they've been selling the S&P 500, they've been selling Treasury securities to do that. And this is one of the factors of a financial repression. Capital is repatriated in this world. The deglobalization which we see of goods and products is a deglobalization of capital, and frankly, nobody cares if British pension funds are selling the S&P 500. It certainly hasn't had a profound negative impact on the price of the valuation. But what if it's the Japanese? What if the next 20 years is the Japanese pension funds having to buy JGBs to keep the yield down, and they're liquidating their portfolio investments, because their portfolio investments are really in America and France. I've just run all the data, and surprisingly, Japanese investors have 2.5 times as much money in French portfolio assets as German portfolio assets. So this is the new capital cycle. And in a world where capital is coming back, every government has the same problem. How do I fund myself? How do I keep my yields down? And we move towards financial repression. So this is some idea how bad it is. I'm picking on the US here simply because we have the data going all the way back to 1951. Really, the war has just ended. This is the total amount of debt in America relative to GDP. It is the government, it is the household sector, and it is the non-financial corporate sector. And look where we are. Much, much worse than World War II. Most people will show you government debt to GDP. But what counts in terms of stability, in terms of fragility of the system, what counts is total debt to GDP. And this is as overgeared as it's ever been. But look what's happening. We are inflating away our debts. If you've been unfortunate enough to buy the newly issued 30-year Treasury in the summer of 2020, you've lost 45% of your capital in nominal terms. It's happening. They are doing it. Now, there's been a little opportunity to make some money over the last 3 or 4 months in bonds, but it's working. This has to come down closer to here. This system is too fragile. It cannot be allowed to persist. Let's look at some other. China. Now, this is absolutely stunning. This is at 308% of GDP. 252. China is now much more geared than America. Let's go back to 2007. We were at 150% of GDP. It's more than doubled in peacetime. There really hasn't been an economy, a major big economy in the world that's managed to double its debt GDP ratio in peacetime. But China has achieved it. And it's now a much worse situation than the United States of America. We know how to inflate away our debts. We know how to deal with debt deflations. We know how to deal with collapsing property companies and banks. You print money. This country needs to print money. And if it prints money that is incompatible with a stable exchange rate, that bedrock of the global monetary system, that link between the renminbi and the dollar, chosen by China, never in consultation with anybody, begins to come to an end as they have to solve this problem just as much as we need to solve this problem. Probably more than we need to solve this problem. And there's France, 323% of GDP. And a chart that looks not dissimilar to China. And it's radically different from Germany. How, if this half of the room was representing Germany and this half of the room was representing France, how do we find the correct level of nominal interest rates for this economy, France, where you have a debt to GDP ratio of 322%, and this economy, Germany, when you have 200%? And the answer is you don't. It's not possible. There's going to be huge conflict as France needs to inflate away its debts and Germany does not. Anywhere else in the world, this financial repression I talk about means stripping power from the central bank and giving it to the government. If I say that the government can determine the entire yield curve by forcing you to invest in it, that's monetary policy. It's not fiscal policy, it's monetary policy. And if you run that in Australia, you strip power from the Reserve Bank of Australia and hand it to the government. You run it in Norway, you do the same thing. You run it in America, you do the same thing. You do it in Europe. You take money from one central bank and you hand it to 20 governments. The decentralization of monetary power, incompatible with a single exchange rate. So in terms of this inflating away of debt, actually it's Europe that has in many ways the bigger political problems because of this huge diversity. And there's Japan. They've got away with it so far, but ultimately the only way to solve this problem is to inflate it away. 414% of GDP. That means forcing Japanese savings institutions to buy JGBs and sell other things. And those other things are Norwegian government bonds, French government bonds, Italian government bonds, US government bonds, British government bonds. And for a generation, this water we've swum in, what is it based on? Japan runs a current account surplus and pours capital to the rest of the world. What if it's the other way around now? What if the only way this can work is for Japan to be selling our assets? It's a new global monetary system. And I thought I'd put up the United Kingdom because I think it's one of the better places to invest. I think it's got one of the lowest political risks in the world. And I'm going to keep making these statements until somebody starts laughing. Because usually people laugh when you say that. Jump forward a year from now. It's going to have the only majority centre-left government in the world. Majority being the key word. It's a product of the first past the post system that you get majority governments. What's going to be happening in the European parliamentary elections? We've discussed what might be happening in the American election. And the political discount on this might go down. But I put this up because we're also inflating away our debt. It's not good if you own British government bonds. But actually the debt to GDP ratio of the UK is 237. France is 322. And it's gone all the way back to where it was in 2008. So this ambush, which I'm not recommending morally, given what it's done to the wealth of lots of these people, has been rather successful. So these are the ways you can bring this down. I'm telling you it's going to be financial repression, but just for the record, here are the other ways it could be done. I don't think any of these are politically acceptable. But real growth is important, and Stuart mentioned it earlier. A productivity revolution means we solve all of these problems, and you can never rule it out. Mankind is incredible. It can invent amazing things. And perhaps there's something that comes along that gives us that productivity growth that Stuart talked about. And real growth is so high that we don't need inflation. If total growth was 6 and it was all real, we really wouldn't need to be inflating away any debts. But that's a productivity revolution. It's not going to be done in the growth in the workforce. So those are your options, and I'm obviously picking this one because I think it's most politically acceptable. So here we are with these debt to GDP ratios. I think I've already talked about most of them, but you can see the US is much lower than you think relative to everybody else. Sweden, reasonable. Norway is about the same as Sweden, not difficult. We'll come back to Norway and Sweden. But look at this. The lowest in the world are in emerging markets. I was asked to do an after dinner in London about 6 months ago. I said, I'm not doing an after dinner. People don't want to hear an after dinner. Let's do a quiz. So what we did is we put all these names of all these companies on this slide. We put all the data on this slide, and we asked these informed global investors to match them up. Well, I guess you think you know what happened next. All the high numbers were assigned to the emerging markets, and all the low numbers were assigned to the developed markets because we know emerging markets are risky, right? We know that. So if they're risky, they must have the higher debt to GDP. They've got some of the best debt to GDP numbers in the world. So I don't hesitate to say that you should be investing in here. They are also beneficiaries of this friend shoring that we are talking about. This movement of industrial capacity by the West, less reliant on China to elsewhere. They benefit from that capital inflow. The equities are also quite cheap, certainly radically cheaper than the S&P 500, and they're undergeared. I get into trouble for saying this, but Indonesia is less risky than France. It certainly consumes less tear gas per head of population than France. Now, debt to GDP numbers, I'm sure you're all saying, well, look, we see these numbers, they keep going like this. Does it really matter? Because they're obviously quite sustainable. I think that's a good point. And maybe we're better looking at this. Private non-financial sector debt service ratio, Let's make this very simple. Imagine it's your own personal finances. It's the percentage of your income needed to service debt. I just think of that in terms of the whole economy for both the household sector and the corporate sector. Now, the dangerous number, historically, is 20%. If it's been around a fifth of all your income servicing debt and then rates go up, so that's an important second bit. Obviously, if it's 20% and rates go down, not so bad, but 20% and rates go up, you've got a problem. Now, I think you can see who's pretty close to the top of the list here. It's a country called Norway, and if you're from Sweden, Norway was at an all-time peak. The data, by the way, starts in first quarter 99, so Norway's got the highest level it's had since 1Q 99. Sweden's not quite back up to its peak. Canada's at a new peak. But this debate, the debate of 2023 is when rates go up, who's going to get in trouble? And it wasn't the US, and we're all scratching our heads going, what on earth happened? Why wasn't it the US? Well, that's why it wasn't the US. Because it's actually pretty moderate. The private balance sheet of America adapted since 2007 because the household sector de-geared and everybody else took longer term debt. And look at the UK, 14%. So the risks from high interest rates are not where you think they are, they're here. And actually the ones that count are this one and this one, China and France. So if these high rates are going to cause any problems, it's not going to be in the US, it's not going to be in the UK, it's going to be in China, and it's going to be in France. So this lingering risk we have that next year could be a bad economic year, I think you look at France and you look at what China has to do to escape this. And then we look at all the good numbers, they're emerging markets. So you've got to look at emerging markets. Now this is important because this is where it's going up quickly, not just where it is, but where is it rising quickly. You see, if you were in an economy where everybody borrowed for 30 years, it wouldn't matter that short-term rates go up because interest expense wouldn't go up. But these are the countries where actually the debt service ratio was going up pretty quickly. Australia, Brazil, not quickly, but going up. Switzerland, China going up. France, kind of static. Hong Kong, different. It's an offshore banking sector. I haven't got Norway on this, but Norway is going up and Sweden is going up. South Korea, surprisingly, one of the faster ones. So if we are going to look at this tail risk, and we're just now being a bit more specific to 24 rather than talking about the structural changes and the water that you swim in, I would focus on those economies. If France has to inflate away its debts, which it does, and Germany doesn't want to inflate away its debts, then you can't have capital moving freely between France and Germany. If the French determined what their yield curve is, mandated it, it would infect everybody else's yield curve. And it's not possible that that happens. So I'm not for an instant suggesting that you're going to wake up one morning and there is no euro. That's not what this is about. It's about to say that as time goes on, we have to impinge the ability of capital to move freely within Europe because some people are going to need very different yield curves than other people. And you can only do that by putting some barriers to the free movement of capital within Europe. People howl with anguish. Will never happen. But it's already happened. The Greeks did it, and the Cypriots did it. In a crisis in which the debt burden was too high even for the government to handle, capital controls. And there's a wonderful book on the Cyprus crisis. It's written by their central bank governor at the time, who had a fantastic name to be a central bank governor. His name is Panikos. He was appointed to bring calm, by the way. He didn't create the problem. Panikos Dimitriadis came in to fix it. And he says that when Cyprus put in capital controls, when it was a member of the euro, it was the European Commission that requested this. So don't think that these barriers in crisis are beyond the realm of possibility. They're possible. What could change the water that you swim in more than capital controls? The ability to move that capital free. Rana raised it right at the start of her presentation. She raised it and said, look, these are all the things that have happened. But actually, one of the things she said is, and capital move freely. Well, let's see if that is the world that we continue to live in. If you were the entire Norwegian savings system and I forced you to own more government bonds denominated in the local currency, that is a capital control. Now, it's not the form that they used to take. It's different, but it is a capital control. And potentially and probably asking you to own more domestic currency than you otherwise would. And this is the world that we move into. So I want to focus on Japan just briefly in finishing, because I'm supposed to be talking about 2024 and I'm really talking about something much bigger than that, but this would come to fruition in Japan this year. Japan is trying to do two things at the same time which are incompatible. It is trying to hold down its interest rates, short and long end, and it wants to stabilize its currency. Now, the first rule of monetary economics is you can only target one variable at a time, and they're now trying to target two. So it ain't going to work in a market system. They don't want that yen to go any lower. It isn't exceptionally cheap, by the way, which you'll know if you've been to Japan recently. So how could they square the circle? If I'm running Japan, I don't want bond yields to go up, and I don't want the exchange rate to go down. Well, how do I get both? I force Japanese institutions to sell their foreign portfolio assets, buy yen and buy JGB. Now, I think that will happen in 2024. I also think that the Chinese will try to inflate away their debts and the renminbi will float in 2024. What is the number one thing that everybody thinks will dominate 2024? Well, beyond the geopolitics and elections, it's falling US rates. This is more important. We're talking about the structural change of the monetary policy of the world's second and third largest economies. It's much more important than the direction of travel of US rates. It's inherently inflationary, in my opinion, and it changes the world forever. So I'm going to go straight to the investment conclusion. Don't buy long-dated government bonds. I could produce here a lovely chart of the returns on American government bonds since there's been in America, and what you would notice instantly is it tends to be 30-year bull markets and 30-year bear markets. Well, our bear market started 3 years ago, so it's only 27 more years to run. So it doesn't necessarily have to be true, but the history of bonds is they tend to go in very long bull, very long bear markets. The losses may not be in nominal terms. If you cap a yield, there is no loss in nominal term. Capping a yield is a floor under a price, so it could be real, but don't own them. I said this a while ago, but short rates are coming down. They are coming down. Japanese equities. Warren Buffett's a pretty smart man, so what did he do a few years ago? He borrowed lots of yen to buy the most highly geared companies in Japan. If you think a country's going to inflate away its debt, borrow the currency and buy the equity of the indebted companies. It was a macro play. It's working out very nicely, but they're cheap. And this reflation of the entire Japanese economy is to the benefit of Japanese equities. As I've said, the S&P 500, which has become so dominant in portfolios, is now a source of liquidation for everybody who's being forced to buy these government bonds. It doesn't collapse. This is more going to be like a 1966 to 1982 period, a very prolonged period where the drift was down in equity valuations, but actually corporate earnings didn't do badly. Corporate earnings in nominal terms in America did well, just the valuation came down. So that magical gap, mind the gap, as Johannes said, that's absolutely right. This gap is going to close, and you mustn't own the S&P 500. Now, I'm not going to talk about gold because I get into trouble talking about gold too much in a house full of equity people, but there are also gold miners that one can own. And in the world of financial repression, which remember is high inflation, low interest rates, but also the government getting more interested in where you invest, it's always good to have a little bit of savings that you can slip in your pocket and head to Switzerland with. Thank you.
Russell, thank you. That was a masterclass as ever. Last night we established the fact that you have so many jobs that you make me feel I'm not trying hard enough. I think the best job title you have, though, is the Keeper of the Library of Mistakes. What's likely to be the first edition in 2024 going into it?
So can I just say that if you want a really good job title, you have to make it up for yourself. So it's not too late, Tim. There's still plenty of chance to get an even better title. I think the mistake will be this. Short-term rates are coming down. I think short-term rates are coming down. And there's a kind of a great sigh of relief. Oh, look, we got away with that. You know, not many people thought we would get away with that, this sharp rise in rates. But there's a problem. Just because short rates are coming down doesn't mean interest expense is coming down. So debt is constantly being repriced. And a lot of the debt that's being repriced in the first half of this year may have been issued 3 years ago. So a lot of the real pain of higher interest rates is yet to come through. And that's why I focused on those economies. Yeah. So I think the market will breathe a sigh of relief and say it's going to be a soft landing. And for America, I think it is. For the United Kingdom, I think it is. But there are some economies out there where I think we're still yet to see some explosions going off. So I think the great sigh of relief that we're not going to have some private sector debt crisis, I think that will be a mistake. And just a general belief that Xi Jinping can control everything, because that's the feedback I get when I go to see fund managers. Don't worry about Xi. He can control the price of money, the quantity of money, and the exchange rate. Well, he can't. And people price that into their equations. They put it in the equation that exchange rate will never move. And the most interesting thing in finance is the thing it never moves until it does. Because in not moving, you build up these great imbalances, great dangerous imbalances. I've seen it over and over again with managed exchange rate regimes. And that is a variable that everybody puts in as fixed. And the day it isn't fixed, we're not playing chess in 2D anymore, we're playing 3D chess. And that's going to be a hell of a surprise for everybody. And so it's a mistake to assume that will always be kind of stable against the dollar.
Thank you. You talked a lot about how you see a change in the relationship between the government and the central banks. And I know we've got at least one central banker in the room. But what do you mean in practice? How will this manifest itself?
So the job of a central banker is to be concerned with the price and quantity of money. Truth is they've been less interested in the quantity of money in recent years and believe the price is more interesting. But anyway, we'll go beyond that. Those are the two things. That's it. Now, in a world where the government can force people to buy government bonds, they're determining interest rates. That's the first thing. They have a huge role. Now, maybe not the short rate. The central banker will have profound impacts on the short rate, but they'll have profound impacts on the long rate. Now, there's something else that the government can have. It can actually have a direct effect on the supply of money. Now, during COVID, particularly in the United Kingdom, but this was true in France, Italy, and Germany, the government went to the banks and said, we need you to lend lots of money, and we're going to guarantee those loans. It's really important that this money gets into the private sector. And we actually had a really big increase in the growth in bank credit. And for everybody who's an expert on fractional reserve banking, you will know that a growth in bank credit is a growth in money. Only possible because the government said we'll guarantee those loans. The government was then in the business of creating the supply of money. This is where they were in that entire post-World War II period. There's a fantastic history called Controlling Credit of the French post-World War II banking system. The governments really did get involved in allocating and growing bank credit and therefore money. So my question, I mean, it's a very rude question to central bankers, but if the government controls the yield curve and can control banks and the quantity of money, what are you going to do all day?
Yeah.
And the Federal Reserve was there from 1942 to 1951, and what they did all day was effectively write learned papers about what they would do when that system came to an end.
Splendid, thank you. We talked previously about the fact that we have no end of economists, we have no end of political scientists, but we have a distinct shortage of political economists. Yeah. Are we intellectually prepared for this next phase? That's coming?
Probably the most important thing. We're not.
Yeah.
We have lived in a world where you didn't have to worry about all that stuff. And then secondly, and worse, I think, our universities have churned out people who weren't educated in it. Economics and finance became a mathematical pursuit, achievable with numbers. And that was a distillation and a simplification. I live in Scotland. We're quite good at distillation in Scotland. I'm quite a big fan of it, actually, particularly once it's been in a barrel for about 12 years. Anyway, in this business, it's the stuff you throw away. And we kind of, in this water that we swam in, we kind of got away with throwing away psychology, politics, sociology, philosophy. We kind of got away with it. And we produced a generation who know absolutely nothing about it. I'm not saying I know a lot about it. I'm just saying that. So I have lots of recommendations for anybody who's in the investment management business. I would say, do we have any fund managers in the world who are good at this? The answer is yes. There's South Africans and Brazilians. They know about financial repression. They know about politics and markets and meshing them. So there's other skill sets out there we need to get into our industry. Our industry's become far too confined in its skill set. And obviously I'm trying to push back on education as well and get some of these stuff in. And that obviously I would say that you need to read financial history as well. But more Brazilians and more South Africans running developed market portfolios, because I'll tell you, they will see things happening that you don't understand. So for instance, a little boring story here, but I'm an emerging market investor by background.
Yeah.
A couple of years ago, Tim, Harland and Wolff, you know who Harland and Wolff are. Everybody here should know Harland and Wolff, because they once built a very famous ship called the Titanic. And 2 years ago, they put on the board a former Lord of the Admiralty. Harland and Wolff didn't have any business with the British Royal Navy.
No.
They do now. Now, if you're an emerging market investor and you see something like that happening, your sinuses start firing. Developed world investors thought, that's strange, what's he doing over there? So there's a different way of thinking about the political economy, and I think a lot of our friends from Brazil and South Africa and the emerging markets think like that already. So I think there is a skill set we can bring in. It doesn't have to be from academia, it can be from real, live, existing fund managers who have this skill set. We should utilize it.
Splendid. Ladies and gentlemen, Russel Napier, thank you.